Hey, thank you very much, Justin, and thank you all that are in attendance for joining us this morning. As usual, I'll try to keep this quick, 15, 20 minutes or so, and what we're going to talk about here are several different ways that you can go, well, beyond the spreadsheet, the typical term insurance spreadsheet pricing that we've all become very accustomed to. And a lot of times you can look at that and think, well, if I run the spreadsheet, I'm going to find the lowest price out there, and a lot of times we sell on that basis, wanting to prove to the client that, hey, you don't have to shop anywhere else. Look at all these carriers. I've got them all. We've got the lowest price right here. Well, oftentimes, I think that the fact that the thought that you're in competition is in our own heads, and we're not always in competition like we think we are. Now, sometimes you are, and sometimes you do need to come up with a lower price and make sure you have that lowest price. Sometimes health issues pop up, and you need to get that price down a little bit, and there are some ways to do that without really chopping up the policy. Instead of taking an axe to it, we can take a scalpel and lower that premium without drastically lowering the coverage, either the length or the face amount for clients. And I guess I'm talking specifically about term insurance here when we talk about these concepts. And one thing that I want to make clear to everybody is that all these methods I'll be speaking about, you cannot spreadsheet these prices. This is meant to be something that's separate from the spreadsheet. You can sort of go around it or through the back door, but it does require that you conduct some sort of a needs analysis. The sale that's made by someone quoting 100,000, 500, and $1 million, maybe 10, 15, 20, and 30-year term. If you're putting those numbers out for people, then these concepts really won't help you at all. These require you to really find out what the client's needs are, what are their debts, what kind of income replacement do they need, and for how many years. Without that information, these techniques really won't do you a whole lot of good. So with that in mind, oops, I went too far here. Here we go. This is a typical spreadsheet term quote that we'll see, and I pulled this right off of our iPipeline quoting engine a couple of weeks ago. This is the sort of the generic person that we see all the time in these things. The male, he's preferred, he's a non-smoker, he's 35, and in this case, he's looking for $1 million of 30-year term. Now, keep this in mind. This is what we're going to be constantly referring back to. Again, this is typical, and the top 6 carriers there, they're all pretty close. I mean, we've got what, a $4 difference from the lowest to the highest there within the top 6. Turns out Banner is on top at $87.06. So keep that number in mind, because that's what we're going to be working with here. Now, there are 4 methods that I've come up with to help you go beyond the spreadsheet, and this is what we're going to cover this morning. One is laddering coverage. That's not a new idea, but one of our carriers has just made it much, much easier than it's ever been before to ladder coverage. The second concept is to lengthen the death benefit payout. Believe it or not, your clients don't have to receive the death benefit as a lump sum. In fact, several carriers have found a way to reduce the premiums up front by locking the client and their beneficiary into an income stream death benefit payout. Income streams have been very popular with annuities for the last 2 or 3 years now. Life insurance has borrowed that same concept. Another carrier allows you to reduce the premiums in the early years, a lot like buying a term and converting it later. That concept has been around forever. They've now applied this similar concept to a term policy. And then the fourth thing we'll speak about is adjusting the term length. It's not just, term doesn't just come in 5-year increments anymore. You can actually adjust it so that it appears in 1-year increments if you need to, again, take the scalpel to the price rather than the axe and reduce those premiums just a little bit. So starting off with laddering, if you're doing a fact finder, you might realize that your client doesn't need that $1 million, the entire $1 million for 30 years. A lot of times people can save money by matching the term length and the amount to the specific need. It does get a little more complicated. You have a little more paperwork to do, but boy, can you save them money. And this next example here is going to give you an idea of what kind of money they can save on that right here. I happen to use Genworth just because $250,000, they had the lowest price, and you can see it right there. That same $1 million broken up into 4 different $250,000 policies comes to $68.97. Now I'll go back a few screens here. This is our spreadsheet price right here, $87 and change, and on up to $91. So now, just by laddering the policies to specific needs, we've saved the client, what, about $20 a month or so? And not only that, over time, those savings are going to become greater and greater, because if you look at the 10-year term, that's going to drop off. So in year 11, now they're saving another $12 off of that. In year 16, they're going to save another $13.49. So the premium will continue to decrease from that $68.97 that you see right there. In fact, I've actually added up all the numbers over time, and 30 years down the road, the total with laddering, clients are going to pay $17 grand out of pocket without laddering. If they went to that $87 a month number, they would have paid $31,000. I mean, that's huge if you take the time to add up all the numbers. I mean, what client is going to want to pay 31 grand when they could pay 17? That's just about the cost of a new car right there over the course of 30 years. So tremendous, tremendous savings. Again, you won't see this in a spreadsheet. You've got to get creative and get out there and adjust these. It all flows from fact finding up front. Now, one of our carriers has found a way to, I guess, do this one better. And within the last month, Banner Life has rolled out a brand new rider. And it's a laddering rider. So you start with your base policy, in this case the 30-year term, and I put on their riders. Now the riders, if you look at those prices, well, we have $12, $8, and $7 for those, just the lowest price equivalent policies here are just a few dollars more in each case. So that allows Banner now to come in with a total of $54 and change. We started off at $87. And now we're down to 54. So if you need to go down that low, I mean, we've got a tremendous range right there. If you need to save money for the client, if you need to be the winner in competition out there. And I would also say this, I don't know that I would do this every time, any one of these methods. You need to make a living. If you lower the premium, you are also lowering your commission. So be careful and pick your battles. Use this where you need to use it. So just use it where appropriately. At the bottom there, I've got an example I had come up with here. What situation might a person want to do this with laddering? Well, we thought we've got this 35-year-old, and he plans to retire at age 65. So he needs 30 years of income replacement for his spouse. Well, we've got that with the $250 a 30-year term. Now, he and his wife bought a house 10 years ago. They've got 20 years remaining on the mortgage, so we've got $250,000 to cover that remaining time and amount on the mortgage right now. They've got 2 children. One is now 5 years old, so figure on a 15-year term for that one. Takes a child to age 20, and they should be at college, hopefully out of the house. Then that income replacement need would go away. Same thing for the 10-year-old. 10-year term might be appropriate to take some child up to age 20. Hopefully they're no longer a dependent, and that portion of the person's income is no longer needed. So you could do the same thing for any of your clients. The numbers will work out differently, but there's a very uniform concept to take a peek at. And I'm going to move on to the second method right now. Some of you may have worked with this already, the income stream death benefit. We've all seen on life insurance policies that we've delivered, the client, or I should say the beneficiary, always has several options as far as how they receive the death benefit. Typically, people will just take it as a lump sum. They could take it as an income stream. They could let the insurance carrier hold that money at interest and take the interest or take it later, do whatever they want. Well, people still have that option, but with these three carriers you see here, they're actually going to give the insured a discount on the front end if they make that decision for the beneficiary. So instead of getting a lump sum, the beneficiary is going to get an income stream. Instead of $1 million, they're going to get 50 grand a year for 20 years. Now the insurance company can charge a lower price because they don't have to come up with $1 million right away. All they have to do is come up with 50 grand for 20 years. And so it makes a lot of sense. The insurance company's happy, the client's happy because they can save a tremendous amount on their premiums. Now they do make provisions in there so that the death benefit could be structured with a lump sum up front, followed by an income stream. If there are some debts and immediate needs to be paid off. Give you an example of what the pricing looks like with these three carriers that offer this. I put our banner price back in there just for reference. That was the lowest one out there for the lump sum. But look at this. If we want that death benefit paid out over a 20-year time period, now we're down in the 70s. So we're saving the client about $15 to $17 a month. We'd like that paid out to the tune of 33 grand a year for 30 years. Now we're down into the 60s. So now we're saving about $20 a month. And then American General does allow for a 40-year payout. So this would mean the beneficiary is going to receive 25 grand a year for a total of 40 years. And now we're down, what is that, about $25 a month or so. So tremendous premium savings there. Now, not only can this concept help save money on premiums, but it might actually be preferable for some folks out there if they don't trust their beneficiary. Maybe the spouse isn't good with handling money, or maybe they're pretty sure the spouse is going to get remarried shortly, and they don't want that new husband or wife to benefit from that death benefit there, that whole $1 million. Maybe they'll go out and blow it and go on vacation somewhere. Who knows? But you can control that from beyond the grave with this payout. I also see it with younger beneficiaries. Parents are afraid of what their 20 or 25-year-old might do with that money if it's supposed to last them several years. This is a way to control that. They're only going to get a piece of it over time. Of course, we've got the tremendous premium savings there. Moving on to the third concept, reducing the premiums in the early years. Now, Banner is the only carrier that we have that does this right now, and basically what they've done is taken their 30-year and their 20-year term and rearranged it so that the client starts out paying the same price as they would on a 15 or a 10-year term, respectively. So the 30-year starts out priced the same as a 15-year, but then each and every year the price is going to go up. So we have an increasing premium term policy here. And give you an example of what happens with that. We've got a lot of numbers here, but I've highlighted the important ones. And if we look at year one, you'll see that Banner's op term 30 for reference, $1,044. That's our same $87 a month premium right there. And that stays level throughout. So if that's too much for the client right now, chances are they could afford $488, which works out to about $40 a month. So now they can have the coverage they need. They can have that $1 million of coverage, and it's going to be there for 30 years. It's fully convertible for the whole 30 years too. But now it's in a range that this client can afford. Now hopefully they'll be making more money down the road. They'll have additional resources. Maybe some bills they have today will go away, and they'll be able to afford the premium as it goes up. Now it takes a while for that premium to get back to that $1,044. So I've highlighted year 12. That's our crossover point. So the client has seen 12 years of savings where they're paying less than they would have had they purchased the lowest price 30-year term on the market. 12 years of savings. Now, how many of your clients actually keep a term policy for 12 years? And there's some of them out there that do, but a lot of these get replaced because something better has come along. The client's needs have changed. Maybe they've got a new house, and now they need a whole new, fresh 30-year term. The chances are they'll replace what they have. They'll get something new. Maybe they'll convert what they have and get something new. People drop policies as well. So, going on that premise that a lot of folks don't keep this the whole 30 years, why are we asking them to pay more money when they really don't have to? So year 12 is your crossover point. Now, even though at that point on you're paying the same or more than you would have initially, you've still seen all those savings for those 12 years. And that's why we've got the cumulative premium column. If you look at year 20, you'll see that's where our cumulative premium finally crosses over. So it takes 20 years before the total cumulative out-of-pocket finally exceeds what they would have paid with the traditional 30-year term. So, really it's 20 years of savings on premium there. And of course, at the end, they'll pay more out of pocket for this life value term. Now, one calculation I did not bother to do was the time value of money. The dollar is worth a lot more today than it's going to be 20 or 30 years down the road. I bet if a person did a time value of money calculation that this would probably end up being a wash. You'd be dead even with that. All your early year savings will more than make up for having to pay more actual dollars down the road. So that's the life value term. That's a way to adjust the premiums up front and lower them. Again, this gets us down from $87 to about $40. So I think that's about the lowest we've been able to go so far. The fourth method, and the last one I'll speak about here, is adjusting the term length. A lot of times we think of term and insurance in terms of 10, 15, 20, 30, or maybe 25-year term. Everything's divisible by 5. Well, people's needs aren't always divisible by 5. Sometimes it helps if we can chop that up a little bit finer, and some carriers allow us to do that. And in fact, I'm going to give an example of American General on our spreadsheet, the iPipeline quoting engine. You can actually quote American General's terms, their selected term, in the 1-year increments. But they're actually not the only one that does that. Some of the newer term policies that come on a UL chassis have that flexibility built in. You've got to go into WinFlex Web and run it and plug it in there specifically. So it does take a little bit more work. But I said none of these things are spreadsheetable. They're going to take a little bit of work. So you can do this with Genworth Life, with Transamerica, and also with West Coast Life, because their term policies are now on a UL chassis. But here's an example of what you can see here. The base price, $87.06 with Banner. Depending on where you need to be with the client, who you're in competition with, we've got several prices there that you can go down to. Now, I wouldn't recommend showing all these to a client, but if I don't know, if $80 is the number to beat, you can show them a 27-year term and say, well, look, we're only chopping off 3 years, but chances are your needs will change between now and then. We can get you in at $78 a month. This also would work fantastic for a person who has an existing mortgage. Say somebody refinanced, 3 years ago. Well, they don't need a new 30-year term if you can beat the price that they're at. What they need is a 27-year term, because that's the amount of time remaining on their mortgage. So you can actually sell them a 27-year term or a 23-year term. You can be very, very precise in matching the policy you sell to the client's exact needs. Now, another scenario I thought of where this might work, and this is probably more common. What if you apply for your client at preferred rates? Client has a paramedic exam, and then something shows up. Maybe there's something they forgot to tell you. There's something in the doctor's records. Doctor says, oh, you're fine. But you know what? The doctor put something in the records to cover themselves. Maybe the client admitted that they had a cigarette 2 or 3 years ago. Well, they didn't tell you that. They told you they're a non-smoker. Well, whatever the case, they've gone from preferred to standard plus. So $87 is now turned into $128 after the underwriting decision. Now, you might be able to place that. I hope you can. But a lot of times it's just not going to work with that big of an increase. That's about a $40 increase. So with this adjustable term in 1-year increments, you can knock that price down as low as you need to until the client is willing to accept the offer. In fact, if we go all the way down to a 22-year term, now we're back in that quoted range. We're within $1 of what we originally quoted the client. Now, most folks could probably handle a little bit of an increase over what you quoted them. If we only go down about halfway, then we're looking at a 25-year term, and 107 sounds a lot better to me than 128. when we were thinking everything was going to cost $87. So to recap, the 4 methods for going beyond the spreadsheet for reducing a term insurance price if you need to. One is laddering. You can do it the old-fashioned way by writing separate policies, or Banner has recently made that more convenient for all of us with their riders. Several carriers allow you to lengthen the death benefit payout by adjusting that end of the policy. Just like we adjust the term length on the front end, we can now adjust the death benefit payout on the back end. West Coast Life, Transamerica, and boy, I forget off the top of my head who the other one is that does that right now. But we have 3 of them, if I remember right. Of course, Banner Life allows us to reduce the premiums in the early years. And a few of these carriers, especially those on the UL chassis, they're going to let us adjust the term length in 1-year increments. So we can be very, very precise with that. The death benefit lengthening, that the 3 carriers were American General, Transamerica, and West Coast Life. And again, keep in mind, one thing they all have in common is they require you to conduct some sort of a needs analysis in order to get to this point. So go beyond the spreadsheet. You can avoid the price battle, still win the war. If any of you have questions, I'm going to try to hang on here a bit. You can type them into the computer, and if I can work the technology here, I should be able to see them. If there's anything I didn't cover. And, by the way, if you're not able to type or can't get them in there quickly enough, I'm available here the rest of the day too to review these. It looks like we have one here. Adjusting the term lengths. How small of a term can you have? For example, 8 years. With American General, with that selected term product of theirs, they'll go down as low as a 15-year term in those 1-year increments. So it's really meant for those longer terms. On the products that are on a UL chassis, I haven't tried anything that low. I know you can, you can even take their 15-year term and turn it into a 12 or a 13 or 11. I haven't tried that with the 10-year product. I would imagine you could. It's just a matter of plugging in the length of guarantee and the length that you want the client to pay. I have found, though, that if you go below 10 years, that you're really not going to see a savings out there. Back when carriers offered 5-year term and all that, nobody sold it because you could find a 10-year term with somebody for a lower price. And even the annually renewable or yearly renewable term, once you hit about year 3 or 4 of that, then the client's paying in more money than they would have for the most competitive 10-year term. So, I haven't tried it. I think you could do it. I'm not sure how practical it's going to be when you get into single digits of terms there. And we'll see if I have a few more questions. I will say this, if there's anybody else out there you know of, any other producers who you think would benefit from a webinar like this, from this information, by all means, don't keep us a secret. We're never too busy to see who else we can help out there. And, of course, a $1,000 agent referral bonus, well, that doesn't hurt a bit at all out there. So I may wrap this up quickly here unless someone else has another question that they're trying to type. But I don't see that there. I'll put in a little plug for next month's webinar. It's going to cover Index Universal Life and how to use that for retirement planning, maybe for college planning, and some other uses. And I'll be having a guest speaker or two from some of our leading carriers to present that webinar on Index Life. And I don't see any other questions out here, so I think I'll wrap it up. I want to thank you all once again for attending, and I hope these ideas have been helpful. Any questions, give me a call here, and you guys have a great day.